Well, the markets are appears flat, especially because the benchmarks are flat. But pull up the small cap, mid cap end of the section, you'd see what I'm talking about. It's a vibrant market out there, but calls for corrections are only getting louder. So let's take that part of the discussion forward. Ajay Tyagi is now joining us from UTI Mutual Fund. Ajay, afternoon. Thank you so much for your time. Ajay, let me start our conversation with the issue which is at hand, and just today one of your industry colleagues also tweeted about it, and we are also trying to scratch our heads that if I may use that word, the liking or the craving for Indian equities is, surging like how that one section believes that people are savers are pulling out money out of their fixed deposits and are participating in the market. And if indeed it's happening, Nilesh Shah, of course, of Kotak MC, your industry colleague believes that this is not the right way to look at it, it's MTM gains there. But is that the craving for equity? When you talk to your distributors across the country and look at flows in your own funds, what exactly is the situation on ground?
Yeah, hi, good afternoon, Ajay, and thanks for having me here. You see, you're very experienced, when it comes to the markets, and I don't need to tell you, but possibly I need to tell your viewers that liquidity usually chases the asset class which is delivering. So in this particular case as well, I'm not surprised that people, like you suggested, are taking money out of fixed deposits and putting money into equities because it is the most performing asset class and therefore it will have followers. So quite frankly, it's not as if there is a sudden awakening or reckoning that equity as an asset class makes money in the long run. I think it's that same behavior which repeats itself, which is that anything which just gives you the prospects for 15-16% return with very low volatility or hardly any pain is an asset class which people would chase, and that's what investors in general in India have been doing, retail investors in particular. Yeah.
Okay. Also, let's take this discussion a little forward then. Ajay, everybody is also saying that India's market cap versus world market cap is surging, obviously, because of the economic heft we carry now, the superior growth, etc. But India's share of profits in world share of profits is perhaps not growing in the same pace. When you analyze companies on their profit pools or India Inc., your teams meet companies of all shapes and sizes. What is that end of the metric looking like? Profit pools and the growth in profit pools.
So you're absolutely right once again. And let me tell you, just to simplify this equation, the one metric which captures everything is price per unit of earnings that you are paying, which commonly in the market is known as price earnings multiple. So the price for every rupee of earning or every dollar of earnings that India Inc. is making has been going up. And therefore, I should again caution your viewers and investors in general that we are trading at about 25 to 30% higher than long-term valuations. Now, this is so far as the overall market is concerned. If I were to dissect this further, and if I go to the lowest end of the market in terms of capitalization, which is the small cap, here the numbers are even more worrisome. Small caps are trading at about 50 to 60% premium to their long-term averages. Now, I must mention here that when we calculate these long-term averages, we don't just look at the last 3 years or 5 years or 7 years. We look at data in the fullness of time, and we typically try to capture as much data as possible before doing this analysis, because obviously the growth prospects for India back in 2005 or 2007 were as strong as they are today. From that perspective, mid and small caps are showing a significant premium to their long-term averages. By the way, even large caps are showing and trading at a premium to long-term averages. It's just that the magnitude of that premium is lower in large caps compared to mid and small caps. So really, I mean, I would say mid and small part of the market is showing us a lot of red.
So in this light, the incremental flows for a professional fund manager and such a senior position in the organization, when you contribute to making the call of the house, are you telling your clients to spread out the money, or are you exactly just going about receiving it and deploying it in, even if it is comes with a lot of weight that I'm being forced to deploy this money. How are you managing the role versus the flows?
That's a good question. So we are doing two things. One, see, we can only communicate. As they say that you can take a horse to water, you can't force it to drink. So we can only communicate. And we wish to communicate things just like we see them. So we've been calling a caution for some time now, especially in the small and mid cap part of the bucket. In general, what we've been telling our distributors and our investors is that this is the time when you ought to be investing into asset allocation products like a balanced advantage fund or a multi-asset fund, because they would provide you a downside protection. And at this stage, our asset allocation funds like BAF and MAF are having about 50% into equities and the remaining 50% into fixed income, or in case of multi-asset funds, some portion in gold. Now, this provides a natural downside protection. The other thing is that these are counter-cyclical products. Should the markets correct tomorrow, we would be increasing allocation into equities. So it works towards the benefit of the end investor, again, over a full cycle. So that's one. If I just remain with pure equity products, our suggestion to them has been that look, stagger it over a longer period. This is not the time to make lump sum investments into pure equity products. Try and have a SIP or an STP, and that too over a fairly long period of time rather than just going all in within the next 3 months or 6 months. Yeah.
Fair point. In fact, one of the strategies this morning, Chris Wood, Greed and Fear, goes on to say that there is no question in the fact that India is the best game in town globally right now on superior growth metrics and macros, but at the same time, there is no running away the fact that valuations are expensive. Ajay, I want to talk to you about certain completely ignored areas of the market. Perhaps, who knows when the tide would turn, but at least you can hide there. One is consumer, especially FMCG consumer, and also discretionary consumer. We've been speaking to some of these companies for almost 4 to 8 quarters now. Volume growth has been anemic, and no growth actually. Some categories there are degrowth, and there are no signs in the horizon of turnarounds, even QSR, etc. But what surprised me, at least for QSR, that these companies have not scaled back any of their store expansions, etc. What are your thoughts on these two completely ignored areas of the market?
Absolutely, and I'll add a third one to this. But let me first, answer your question around these two areas. So you see, let me just take a step back to put things into perspective. India is essentially a domestic consumption-driven economy. 65 to 70% of our GDP is basically domestic consumption, and therefore, the fact that Indian consumption through different facets will only continue to propel the overall growth in India should never be lost on us. If you look at the typical consumer oriented sectors, you're absolutely right. Last 6 to 8 quarters have been very weak. Growth has been extremely modest. But if and you just said that India is the best game in town, everybody feels that India is going to be that oasis of growth for hopefully decades to come, then a natural corollary to this is that that growth will happen basis strong domestic consumption, and this domestic consumption would have very, very different legs. It could be staples, it could be durables, it could be discretionary, it could be like you said, QSRs or restaurants and so on. Now, therefore, if India does well and consumption does well, strong businesses should prepare themselves for the growth that is going to manifest itself over the coming years and many years, rather than just thinking about it that last 4 quarters have been weak, let the consumer come back, only then will we plan for growth. I think strong companies usually plan things way ahead, and they plan for things for the medium to long term, rather than just strategizing about here and now. So that's my response to your question. We appreciate companies which are looking beyond the immediate softness in demand and are looking at this equation over the long term. And I was saying that I would add one more pocket of undervaluation to this, and we feel that private sector banks, quite a few of them, and I'm not at liberty to name, but private sector banks clearly are that part of the market which is trading at lower than long-term averages. I did say upfront itself that the markets are trading at a huge premium to long-term averages. Under these circumstances, it's quite surprising that some of the best managed companies in this country are trading at lower or a discount to their long-term averages. Yeah.
You're right. I can understand the name you are nudging or looking towards. We'll not take that name, but there are certain private sector banks which have been kind of ignored and completely kind of the popularity isn't there anymore. Even valuations have actually come down. Do you think that some of these names, which have also got hit because of liquidity issues, the peak of liquidity issues may happen around the election time, uh, because the general view is that the government may not want inflation to go out of whack around inflation, and hence has taken a kind of a view that liquidity in the system should check. So if it peaks out around then, do you think these private banks could breathe a sigh of relief?
I would say, Ajay, typically, uh, you know, uh, when a particular theme starts to play out or a particular theme starts to underperform, people look back and say that, look, this was only obvious. This was something which was just waiting to happen. So, very frankly, I may not be able to call out the reasons today as to when would they start to do well and what is the event that will trigger this. But sometimes it is as simple as the valuations. Sometimes, something which is much loved because of obvious reasons, because of strong growth, but also therefore trading at a high valuation starts to underperform just on account of the valuation discounting everything into the future. Equally, sometimes things which are overdone on the other side, by which I mean, let's say highly undervalued, may just have no other trigger but that trigger of being extremely cheap. And for those investors who are viewing these businesses over a 3 to 5 year perspective in the future rather than just the next 3 months, would just start to buy into them because they find them extremely attractive on valuation. So can't say which trigger would work, what event would work, but suffice to say that we've seen this multiple times in over multiple decades that valuations itself is the biggest trigger more often than not. Yeah,
All right, Ajay, great chatting. Thanks so much for joining us on the show today.
thank you.
That was Ajay Tyagi of UTI Mutual Fund. Very interesting thoughts, and if you go back and listen very carefully, you will find a lot of stock ideas there in that interaction.